Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, January 3rd, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, are consensus earnings estimates and by extension, stock market return expectations too high? Our answers are almost definitely regarding the former, specifically consensus earnings estimates, as earnings estimates tend to peak in Q1 and decline throughout the year. Bloomberg has Wall Street consensus S&P 500 next 12-month earnings per share data since the start of 1990, and that phenomenon has occurred in 20 of the 35 years. Does that even matter, however? After all, investors are exiting a year in which this theoretically bearish phenomenon occurred, and the S&P rallied 23%. That same dynamic occurred in 2023 amid an index return of 24%. It occurred throughout most of the 1990s amid one of the most ferocious secular bull markets in stock market history. All told, we do not believe earnings momentum is the key driver of the stock market. Rather, we view the drivers of the multiple as more determinant of price performance, specifically growth, inflation, policy, and liquidity, especially over a risk manageable time horizon, which we believe and many institutional investors believe is inside of 1 year. Still, the reason we are shining a spotlight on earnings in our research today is because Wall Street consensus is calling for the S&P 500 to return 9% in 2025, with earnings growth, not multiple expansion, being the key driver of the index gain for most strategists. Investors should prepare for disappointment if our triple S's and sticky inflation themes continue to develop. Refer to the left tail risk section of today's January 2025 macro scouting report for more details. Transitioning to our 42 macro dashboard here. As always, we'll wrap up with a question from our community. This one's regarding Doge. It says, now that Doge's official mission has been thoroughly beaten to death, can we talk the real value, which is deregulation? So just quick on the beating of the dead horse here with respect to Doge. If you have not reviewed our what must be done to prevent Doge from failing discussion with our friend Luke Groman over at Forest for the Trees, back I want to say in early December, definitely make time to review that. It's gonna help you get up to speed on a lot of the pending fiscal policy changes and sort of the different scenario analysis that that President Trump and Elon Musk and Vivek Ramaswamy are the different path that they can take in terms of achieving some or significant deficit reduction. We also focused on our most recent Around the Horn presentation, which is our weekly webcast on Saturday. We focused that on Doge as well, so that was a much more in-depth, with much more charts and analysis discussion regarding the outlook for Doge and fiscal retrenchment here in the U.S. So make sure you review those if you're a client or not a client. If you're not a client, you can obviously review the one beyond our paywall with Luke Groman. If you're a client, make sure you review the most recent Around the Horn. Getting into this question, can we talk deregulation? Because to me, I think this is one of the most important aspects. I'll start by saying deregulation is very amorphous and very squishy. What does that even mean? People say cutting red tape. I've never seen a piece of red tape in my life. But we obviously know that, less regulation tends to produce higher nominal GDP growth and so on and so forth. And more regulation tends to restrain economic activity. Quantifying this and monitoring this and building some sort of Bayesian inference process to track changes in deregulation is borderline impossible. I mean, it's a full-time job for policy analysts to do, and I'm not even sure they're capable of transitioning or transforming those insights into credible projections or forecasts for where growth, inflation, stock market, et cetera, are headed. So but I do think it matters, and the reason it really matters in 2025 is because, again, Wall Street is calling for the index to return just shy of 10% this year, and most of the returns, if you look at the various strategists viewpoints, are likely to come from earnings growth acceleration as opposed to multiple expansion, which is much of what we saw for the past couple of years. And so obviously, if we saw deregulation on the mergers and acquisition front, it will allow large cap companies to start to acquire small cap and mid cap growth companies and sort of buttress their own growth and allow the index to grow that way. That's something that very well could essentially sort of support this expectation for an earnings driven gain in the index this year. So I think it's pretty safe to say that we're going to see a more lucrative environment, a more sort of relaxed environment with respect to mergers and acquisitions in 2025 and beyond. So that's obviously very positive in that regard. But how much of that occurs, especially in the context of some of the dynamics that we're observing with respect to the outlook for corporate profitability from a macroeconomic standpoint, there's going to be a push-pull there from the perspective of, where does productivity growth settle out? It's currently above trend. Where does unit labor cost inflation settle out? It's currently well below trend. If those things start to converge, back to their trends or even beyond their trends from the current levels, then you're talking about margin compression as opposed to margin expansion, which is what most strategists are projecting. And that margin expansion is obviously, likely to culminate with a broadening out of earnings momentum and margin expansion and ultimately performance across the index. That's sort of the general consensus view amongst Wall Street strategists. And so, there's a lot to unpack in those views. I don't really take offense to the view that, okay, the index will probably cool down a little bit this year. But what we do take offense is why they think we don't take offense to the index return cooling down. What we take offense to is why is the index return projected to be higher? Why is it positive? If you make the case that we're focusing on earnings growth acceleration and you don't get the earnings growth acceleration, you're probably not going to get the multiple expansion either, because if we don't get the earnings growth acceleration, things that would cause margin compression from here would also cause the multiple to contract from here. So 2025 is going to be a very, very tricky year for investors to navigate. There's a lot of really good stuff coming down the pike, and there's also potentially a lot of really bad stuff coming down the pike. And even if we didn't have a significant change in fiscal and regulatory policy in the U.S., we're just at some very asymmetric points in the growth cycle, the inflation cycle, and the positioning cycle that don't support, sort of necessarily a continued expansion of the index in price terms. So, I think 2025 is going to be a tricky year. There's probably going to be some significant chop on significant volatility intra-year for investors to risk manage. And in our view, that significant volatility may include a crash at some point this year. And I don't mince words about that lightly, because if we start to get a lot of the bad stuff that could potentially come down the pike here, front loaded from a sequence perspective at the starting point of this asymmetric point in the positioning cycle, you could very well see the market crash in 2025. Now, I don't think it's crazy to call that a base case scenario, but I do believe that it's got to be relatively close to your base case scenario is a crash. I think also relatively close to your base case scenario has got to be what the Wall Street strategist consensus is expecting, which is a modest gain in the return. And so this is something we've been talking about with our clients behind our paywall for a couple months now, which is the distribution of probable economic outcomes is now wide and widening, such that, the probability of achieving a modest gain in the index is almost as high as the probability of a crash in the index. And that's very different than where we've been for the past couple of years. Recall that, we've been ragingly bullish throughout 2024. We were pretty bullish for the 2023 and help clients capture the bulk of the upside in 2023. But obviously we're coming off a year in which, consensus was surprised to the upside on growth, consistent with our resilient U.S. economy theme. Consensus was generally surprised to the downside on inflation. And ultimately the Fed's asymmetrically dovish reaction function, which no longer exists, was incredibly supportive of forcing investors further out on the risk spectrum or further or into risk assets in general from their prior hard landing positioning. So I'll end it there. If you want to check out more and get a deep dive on all these different dynamics, we're going to do our January. We're going to publish our January 2025 macro scouting report presentation to clients this afternoon. That'll be about an hour 15 minutes of me going through, the modal outcome scenario, the left tail risk scenario, and the right tail risk scenarios from the perspective of our active themes. And once we, create that full distribution of probable economic outcomes, then we as investors, following our KISS and Dr. Mo signals, which we use, those are systematic overlays that we use to help our clients on the retail side, KISS, and institutional side, Dr. Mo. Those signals, help us stay on the right side of market risk when the market decides it wants to go from pricing in right tail risk, which has been for most of 2024, or all 2024 really, with the exception of August, and then potentially pricing in left tail risk. KISS and our fundamental research process helps clients understand that full distribution of probable economic outcomes. And then our systematic risk management overlay tells our clients exactly when the market is going from pricing in the right tail risk to the modal outcome to the left tail risk. And that's when you need to do something different in your portfolio to remain on the right side of market risk, which is our shorthand euphemism for maximizing upside capture in bull markets and minimizing downside capture in bear markets. So definitely check that presentation out if you want to get smarter about the emergent risk in 2025, both to the upside and downside. And also you want to get a little bit smarter on how you should potentially thinking about risk managing those risks over various time horizons from today. So we'll wrap it up there. Everyone have a wonderful weekend. We'll catch you back here on Monday. Cheers.